I've been saying for probably since at least the beginning of this year, $40 was very likely at some point in the second half of 2025. You know, it was less obvious back then. It's more obvious now since we've all already touched it, but that was my feeling then, and I think it's very realistic still. I also think that, you know, things pick up and they could well, for, you know, different reasons, some black swans and some gray swans to come would potentially bring silver to perhaps $45 sometime before the end of this year.
Gold may be the headline act, but history proves silver is the real underdog. In 7 of the last 9 bull markets, silver didn't just keep pace, it outran gold. And now in 2025, the same setup is falling into place once again. So far this year, silver has climbed nearly 25% in just 8 months, as both investors and industry players have stepped in. But the real story isn't what silver has already done, it's what comes next. Analysts are starting to float targets that point toward levels we haven't seen in decades. Here's the pattern Peter Krauth highlights. Silver typically lags in the early stages of a metals bull market, then takes off once momentum builds. That's when it overtakes gold. History backs it up. In 2020, silver prices increased by nearly 48%, while gold prices rose by 25%. In 2016, silver jumped 15.8% compared to gold's 8.5%. This year's move, roughly 25% so far, is being fueled by 2 forces, investor demand and relentless industrial growth, according to Sprott. Despite the run, silver has yet to reach its old records. The peak was around $49 an ounce in 1980. Today it's far lower, but edging closer. Looking ahead, Krauth expects $40 silver to be realistic by the end of 2025, with a potential spike toward $45 if a shock event rattles the market. The all-time high was near $50? He thinks that's more likely to arrive in 2026 rather than this year. Morgan Stanley makes a key point. Silver's lower price point gives investors flexibility. It's easier to adjust positions and respond to market shifts. That dynamic, combined with rising industrial demand, is what keeps silver positioned as the metal most likely to surprise. Make sure to tune in for our expert analysis. Don't miss out on future content. Hit the subscribe button and turn on notifications to stay in the loop. Your support is greatly appreciated.
So the structural deficit, according to the Silver Institute, is pretty significant. It started back in 2021. I'm looking at their numbers right now. There was a deficit of about 80. So again, for your readers to just get a very big overview, the silver market is about 1 billion ounces a year of supply, and demand currently in the last few years has been from 1.15 to 1.2 billion ounces. So we're using up about 15 to 20% more than we're producing every year. Or when I say supply, really the supply is about 85% from mining, about 850 million ounces, and about 150 million ounces come from recycling. So total billion ounce supply every year, total demand about 1.15, 1.2 billion ounces a year. So this shortfall of anywhere from 10 to 20% that we've seen over the last 4 years and is forecast to be sustained again this year, that's going to mark the 5th year in a row that we've been going through a structural deficit. And, Elijah, you and I have talked about this before. Where is the silver coming from? How can you run a deficit this many years running? And so last year I started to dig into that and I came to the conclusion that especially industrial consumers of silver, which absolutely need their silver, investment demand is one thing, although if people really want silver, they're going to pay for it and probably find it somehow. But the industrial applications in many cases are either very difficult to substitute or it's irreplaceable. So that's very much the case in a lot of silver applications. So as far as I'm concerned, industry has been able to tap into these secondary supplies of silver, which, maybe for about a decade prior to 2021, we were on balance producing more silver than we were consuming. and that has flipped completely. So this excess silver had been accumulating in inventories, which are mostly, at least identifiable inventories, are the COMEX, the LBMA, and Shanghai. Those are the big ones. You've also got private hoards of silver that's owned privately, which, accounts for probably a few billion ounces as well. So I think what's been happening is that these industrial consumers have gone to these secondary inventories, the futures markets, and even to some extent to the ETFs, and have been basically drawing down from there. So they've been able to access, I'm going to say, excess supply, because this is above ground inventories that are just sort of sitting there. They've been able to access this supply, draw it down, buy it at prevailing market prices without putting pressure on miners and recyclers to bring additional supply to market. And I think that's why we haven't seen silver really truly break out, go beyond sort of this $45, $50 level, which will be the true ultimate breakout. That's where I think the supply has come from, and it hasn't, as I say, put tremendous pressure yet on the silver price. But I do think that that's coming, and that's really what makes silver very undervalued, and perhaps one of the most undervalued assets right now, and bodes very well for the future, both for the metal and for the miners that look for it and produce it. I actually hope that this consolidation will continue a bit, and that we may even see a bit of a smallish correction. I think that would be the healthiest thing for this market. It is quite solid and quite strong, and I do believe that it's very healthy. The last few times that we were at these price levels, if we look back a decade or a decade and a half almost, things had gotten ahead of themselves. And then after that, it was in correction mode around, those high 38s or even 30s. So this time we've gotten there much more gradually, and I think this is a clear sign of a growing bull market and much higher prices to come. But as you said, we ran up 30, 32, 34, 36, 38, up to 40 even in the futures prices, and now we've corrected back to 37 and change. I really think that we're due for at least consolidation. My ideal would be to see a little bit more correction. Frankly, a couple dollars off of the price would be very healthy. That may, take a little while longer, a few more weeks, maybe a month or two, probably not even that long, but that would be the best thing. And then we would probably continue to head considerably higher through the rest of the year.
And what kind of prices do you expect going into year end?
So I think that we're going to see probably something along the lines of, and it's not a stretch, but $40. I mean, I've been saying for probably since at least the beginning of this year, $40 was very likely at some point in the second half of 2025. It was less obvious back then. It's more obvious now since we've all already touched it, but that was my feeling then, and I think it's very realistic still. I also think that, things pick up, and they could well, for, different reasons. Some black swans and some gray swans to come would potentially bring silver to perhaps $45 sometime before the end of this year. I'm not sure that it would necessarily stay there, but, the all-time high of $50, I think, is very much within range, but probably at some point only next year. That's been my expectation for some time, and I still feel that way about where silver could be going. There's always this argument that, we're not going to run out of silver. There's plenty of silver that's being held by private investors, and that they will, so to speak, dishoard their silver as the market requires. And I don't disagree with that. I guess where I disagree with some observers or analysts is the price level at which these people are going to be willing to sell their silver back into the market. And these are in many cases what we call stackers, silver stackers, and they're adamant about buying and holding on to their silver. They're not prepared to let go. Many of them will not let go at any price. I'm willing to admit that you will gradually get high enough prices that will have them, sell their silver back into the market and help provide supply. but I don't think it's at $33 or $35 or even $38. I think it's going to be a lot closer to $45, $50, $60, and $70 that we're going to see that supply come to market. So, and that's, that speaks to your question, which was, what that's going to do for silver. Well, I believe that we will get this demand met to some extent, at least, not fully, probably, but to some extent it'll be met, but at much, much higher silver prices. And that's where silver needs to go if you look at these structural deficits, because these secondary inventories are down about 70% over the last 4 years. And there's no sign of that ending. In fact, the Silver Institute themselves have said that, that was, I think, in this year's silver survey, annual silver survey, they said that they thought that we're going to see these structural deficits continue for at least the next 5 years, and that we would probably see new record deficits being set along the way, because mine supply has just been completely incapable of bringing out any meaningful new growth to silver. We peaked in 2016 at 900 million ounces of silver from mining. Today we're at 835 million ounces, and yet we're facing bigger deficits than we've ever seen. So, it's tough for the industry, but it's fantastic for investors.
Peter Krauth points out that silver's industrial demand isn't easing, it's accelerating. Around 1 billion ounces of silver were produced from mining and recycling last year, and nearly 70% of that was used directly in industrial applications. Solar energy alone accounts for 20% of the global supply. The Silver Institute has projected industrial demand will flatten this year, but the numbers don't back that up. China installed more solar capacity in just the first half of this year than in all of last year, which suggests photovoltaic demand for silver is still climbing, not leveling off. Some argue that there's a substantial amount of silver held in private hands that could return to the market if prices rise. Krauth agrees in principle, but he stresses that the real issue is price. Most stackers aren't interested in selling at $33, $35, or even $38. They're holding out for $45, $50, $60, or more before they're willing to let go of their supply. In other words, it will take a sharp price surge to shake loose that private metal. That's the setup Krauth sees unfolding. Tight supply, growing industrial use, and a wall of silver held back by higher price targets all point in the same direction. Upward pressure on silver for years to come. Let's get back to the interview.
If you look at the forecast for investment demand of physical silver, I'm looking at the numbers from the Silver Institute again, and they see a little bit of growth, sort of moderate growth over last year. It was 190 million ounces of coin and bar demand. They see it at 204 million ounces for 2025. I think that's actually going to be, once again, an underestimate. That's only 7% growth. I think that if you look at different places like India, China, Turkey, Egypt, and then if you look at even at the West, the amount that there's been of sales of physical silver at places like Costco, Walmart, and so on, I think that we're going to see that number is going to turn out to be much too low, about 204 million ounces going to physical investment this year. The way the Silver Institute presents their numbers, they show total supply and total demand. However, the investment of silver that goes into ETFs is shown outside of those two numbers in terms of the balance. If you exclude silver flowing into silver ETFs, then the deficit, the structural deficit that they're forecasting for 2025 is going to be 117 million ounces. However, and I think frankly that it's a little unfair to not include the silver that goes into ETFs, because by the same token, silver that gets purchased physically as opposed to buying ETFs, I mean, their argument is that, that silver is not consumed, and that silver can easily flow back to the market to be consumed if necessary or whatever. Well, you can say the same thing for physical silver. It's not consumed if it's bought, for investment purposes. It's purchased, and that could easily flow back. So I feel it's more fair to include silver that goes into silver ETFs in terms of overall demand. So they think that that's going to grow pretty significantly. They said it was 60 million ounces last year. They think it's going to be 70 million ounces this year. Again, I think that's going to be an underestimate. But here's the really interesting part. If you leave out silver in silver ETFs, then, as I was saying before, your deficit for 2025 is forecast at 117 million ounces. But if you include the silver that's going to flow into silver ETFs for the forecast, your deficit is 187 million ounces. And that is a much, much smaller drop than is forecast when you exclude it in terms of the deficit. In other words, the deficit will be almost the same as last year if you include silver flowing to silver ETFs. Now, there's a lot of numbers and facts and figures being moved around there, and it might get a little confusing, but let's just kind of keep it at this, or to summarize. The deficit expected for 2025 should be 117 million ounces, which is less than last year. But if you include silver flowing into silver ETFs, the deficit is expected to be very close to last year's. So I think it's very significant, and I think that it's going to have impact. And I also think that, their estimates are too low in terms of, not being sort of fair or aggressive enough in terms of, the investment demand for silver. Think about this. We're close to all-time highs in gold. Gold is arguably, I suppose, there's different ways you can look at it, but it's not as cheap as it was. I would still consider it cheap, but it's not as cheap as it was. And yet silver is still very cheap. And if you look at the gold-silver ratio, there's no doubt on that basis, it's still very cheap. You see gold start to take out 3,500 and 4,000 in terms of, these psychological levels. People will really start to pay a lot more attention, and they're going to say, I'm getting 1 ounce of gold for, $4,000, whereas I can get 40 ounces of silver for the same price. I'm not even sure if my math is right there, but it's 100 to 1. So I think it's something like that. And they're going to start to ask themselves if silver is at, if we make it easy, $4,000 versus $40 for an ounce of silver. It's 100 ounces of silver for 1 ounce of gold at that point. And so people are going to say, you know what? Why don't I just buy some silver? And I don't even have to buy a full ounce like I would have to. You don't have to buy a full ounce of gold, but it's a lot more common. You're getting arguably a lot more for your money. And I think that is going to drive a lot more buying silver as well. Industrial consumption has been going up. The Silver Institute is forecasting that this year it's going to be slightly down from last year, total industrial consumption. But consider this. Total supply last year, if you forget about secondary inventories, just supply from mining and recycling of just about 1 billion ounces, yet industrial alone was 680 million ounces. So 68% of all of the mined and recycled supply went strictly to industrial uses. And photovoltaics, which is solar, represents 20% of demand of all of the supplied silver every year. So this one application is 20%. The Silver Institute thinks that we're going to see solar kind of, the demand from solar for silver kind of flatline, and industrial demand as well overall more or less flatline this year from last year. I think that's going to turn out to be wrong. I think that they're underestimating the demand. I can point to things like, you talked about AI and data centers. I saw some numbers recently about solar installations in China. And because of government stimulus, it's gone through the roof in the first half of this year, and it's gone well beyond. I think that the first half of this year has already surpassed last year, all of last year, in Chinese solar installations. And as we know, they're the biggest producers of solar, the biggest installers of solar. So that really suggests that demand for solar will continue to go up, and the required silver along with it.
The Silver Institute acknowledges the market is set to face at least 5 more years of structural deficits. Each year is expected to set a fresh record for shortages. That's a serious challenge for industries that rely on silver, but it's also precisely where the opportunity lies for investors. When demand outpaces supply year after year, there's only one way the market can adjust. Prices have to rise. Silver's industrial role is unlike anything gold offers, providing it with a built-in demand floor that continues to grow. Each solar panel requires approximately 20 grams of silver, contributing to the global effort to promote renewable energy. With solar installations booming worldwide, especially in China, this single application already consumes roughly 1/5 of the annual supply. What stands out now is how silver is caught between two forces pulling in the same direction. A steady stream of industrial needs that shows no sign of slowing, and investors unwilling to part with their holdings until far higher prices are reached. Add in persistent supply shortfalls, and the setup looks less like a passing trend and more like a structural reset in how this metal is valued. Is the stage being set for silver to break out of its historical role as gold's sidekick and take center stage in the years ahead? Share your perspective in the comments section. If the video resonates with you, join our community by subscribing to our channel and enabling notifications with the bell icon. Thank you for being a part of our community.